Let me start with a quiz. From 1926 to 2016, approximately 26,000 stocks were listed on U.S. exchanges. Of those, how many outperformed U.S. Treasury bills, the safest asset you can own? 80%? Stocks go up over time, right? 60%? Surely more than half. Or 43%? Less than half? The answer is 43%. 57% of all stocks failed to beat the return of risk-free Treasury bills. But here's the number that should really shock you. All of the stock market's net wealth creation above Treasury bills, every dollar of it, was generated by just 4% of stocks. The other 96% combined merely matched T-bill returns or worse. Stocks go up in the long run is true, but the gains come from a tiny minority of winners. Why this matters, and what to do about it, is what we'll cover today. The man behind this research is Hendrik Bessembinder, a finance professor at Arizona State University. His 2018 paper in the Journal of Financial Economics, Do Stocks Outperform Treasury Bills?, sent shockwaves through the investment world. Let's dig into the numbers. Out of 26,000 stocks, just the top 50, a mere 0.2% of all listings, created roughly 40% of the entire stock market's wealth. The top 5 stocks, ExxonMobil, Apple, Microsoft, GE, and IBM, alone accounted for about 10%. In 2023, he expanded the study globally. 42 countries, 64,000 stocks. The results were even more extreme. The top 2.4% of stocks explained 100% of global stock market wealth creation. In the updated U.S. data through 2022, the top 5 shifted to Apple, Microsoft, ExxonMobil, Alphabet, and Amazon, now accounting for about 14% of total wealth. Why does this happen? The answer lies in the shape of stock return distributions. Stock returns don't follow a bell curve, a normal distribution. They follow an asymmetric distribution with a long tail stretching to the right. This is called positive skew. Here's the key insight. The maximum you can lose on any stock is 100%, your entire investment. That's the floor. But the maximum you can gain has no ceiling. 10x, 100x, 1,000x. There's no upper limit. This asymmetry creates a fascinating phenomenon. The average return across all stocks is positive because a handful of massive winners pull the average up. But the median return, the return of the stock right in the middle, is negative. More than half of all stocks actually lose money. Think of it this way. 10 people are sitting in a room. Jeff Bezos walks in. The average net worth in that room is now billions of dollars. But the median net worth barely changed. The stock market works exactly like this. Okay, the theory makes sense. But what does this actually mean for people like you and me who are investing real money? Let's look at 3 examples. First, the S&P 500's dirty secret. The S&P 500 has returned roughly 10% per year over the past 30 years. If you think that means 500 stocks each going up about 10%, you'd be completely wrong. In reality, the top 10 stocks, Apple, Microsoft, Nvidia, Amazon, drive the vast majority of the index's returns. The bottom 200 to 300 stocks barely contribute, and many are actually a drag on performance. This is the real reason behind the advice, just buy index funds. Picking the top 4% on your own is nearly impossible, but an index fund automatically includes them. Second, the odds of, I'm a good stock picker. Bessembinder ran 20,000 simulations. He randomly selected stocks and held them long-term, then calculated how often these random portfolios beat the market. A 25-stock portfolio? Only 37% chance of beating the market. 100 stocks? Still just 43%. No matter how many stocks you add, a random portfolio never reaches a 50% chance of beating the market. Why? Because missing even a few of those rare mega winners immediately puts you behind the index. And mega winners are, by definition, rare. This is the fundamental reason why 85 to 90% of active fund managers fail to beat the index over 15 years. It's not because they lack skill. The distribution itself is stacked against them. Third, this isn't just an American phenomenon. Bessembinder's 2023 global study across 42 countries found that wealth concentration is even more extreme outside the United States. In every major market, Europe, Japan, emerging markets, a tiny fraction of stocks drives nearly all the returns. The pattern is universal. So now you know the distribution is rigged. How should this change the way you invest? 3 strategies. Strategy 1. Core Satellite. This is the classic portfolio structure for investors who understand Bessembinder's law. Your core, 70 to 80% of your portfolio, goes into a broad market index fund, or ETF. This is your insurance policy against missing the top 4%. The remaining 20 to 30% is your satellite, individual stocks you have high conviction in. You're swinging for the fences, but limiting the damage if you're wrong. Strategy 2. Let your winners run. In a positively skewed distribution, do you know what the most expensive mistake is? Selling your winners too early. 57% of stocks won't even beat Treasury bills. You can't avoid that. But if you happen to own one of those rare top 4% stocks and sell it at a 2x gain, you just missed the 10x. This is the single most common pattern that destroys long-term returns. Peter Lynch put it best. All you need for a lifetime of successful investing is a few big winners, and the pluses from those will overwhelm the minuses from the stocks that don't work out. Getting 6 out of 10 right is enough. The key is letting those winners compound. Keep your stop losses, but don't cut your flowers too early. Let your winners run. Strategy 3. Accept the limits of diversification. Remember the numbers. 25 stocks, 37% chance of beating the market. 100 stocks, still only 43%. More diversification helps, but it never gets you past 50%. And managing 100 individual stocks is unrealistic for most people. That's why the core should be an index. One fund, hundreds or thousands of stocks. Automatic diversification. Before every investment decision, ask yourself one question. What is the probability that my portfolio includes the top 4%? Let's recap. The stock market is not a fair game. A tiny minority of winners drives all the gains. The majority of stocks can't even beat Treasury bills. If you don't know this, you fall into the trap of thinking, I just need to pick the right stocks. If you do know this, you start asking a different question. How do I build a portfolio that doesn't miss the winners? That shift in thinking is what separates long-term wealth builders from everyone else. Now, your favorite YouTuber just nailed 3 stock picks in a row. Is that skill or is that luck? In the next episode, I'll show you the math that separates the two. Thanks for watching. If you found this useful, hit the subscribe button and the notification bell so you don't miss episode 2, where we break down whether stock picking is skill or just luck. See you in the next one.